I have said before, and I will say it again, the big money is never in the buying or the selling. It is in the waiting. But what most men never learn is that the real destruction of profits does not come from bad entries. It comes from bad exits, from fear, from impatience, from the itch to do something. You see, a man may study charts day and night. He may learn support and resistance, learn to read accumulation, learn to spot a breakout forming as clearly as smoke before a fire. He may buy correctly, and yet he will not make money. Why? Because he does not know how to leave a trade alone. Have you ever closed a position because you were uncomfortable? Not because the chart told you to, not because the trend reversed, but because your nerves could not bear the open profit shrinking a little. That is what I call an expensive habit. The market does not pay you for being right at the exact top. It pays you for sitting tight while you are right, and sitting tight is something most men cannot do. They think activity is intelligence. They think quick profits are proof of skill, but the market does not reward excitement. It rewards discipline. When a stock breaks out of a sound base on heavy volume, that is not the end of the move. It is the beginning. The chart tells you the story. Higher highs, higher lows, strong closes, volume expanding on advances and drying up on pullbacks. The tape is speaking. But what does the average trader do? He takes a small profit at the first sign of a dip. He fears losing what he has made, and so he guarantees he will never capture the larger swing. Tell me, how can a man build wealth if he cuts every winner short and lets his fear dictate the exit? Now, I am not speaking against protecting capital. Far from it. A trader must always know where he is wrong. A loss must be small and quick. That is sound speculation. But a profit must be handled differently. A profit is not a fragile thing to be grabbed and pocketed at the first trimmer. It is a seed, and a seed needs time to grow. The chart will show you when you are wrong. A break of structure, a violation of trend, a heavy volume reversal through support. That is information. That is evidence. But a minor retracement within an uptrend, that is noise. And most men cannot tell the difference because they are watching their profit and loss statement instead of the price action. You must learn to watch the market, not your money. Have you noticed how a strong trend moves? It advances, it rests, it shakes out the weak hands, and then it advances again. Those little pullbacks are designed to test conviction. The market asks you, do you truly understand what you own? If you do not, you will sell. If you do, you will sit. The greatest fortunes in speculation have come from major trends, not from 10-point swings snatched nervously, but from the patient holding of a position while the primary move unfolds. And yet, most traders behave as though the market will disappear tomorrow. They rush to close, rush to lock in, rush to feel safe. Safe from what? From volatility. Volatility is the cost of admission. Let us speak plainly. Exits kill profits when they are driven by emotion instead of structure. A man buys a breakout at 50, it runs to 55. He feels clever. Then it pulls back to 53. He feels foolish, so he sells. The stock then marches to $70 over the next 3 months. Was his analysis wrong? No, his patience was wrong. You cannot build trading capital by harvesting pennies and forfeiting dollars. Study the weekly chart as well as the daily. Learn to see the broader structure. Is the stock in a primary uptrend? Is the industry group strong? Is the general market in harmony with your position? These are the conditions that justify staying in. But if you focus only on the 5-minute fluctuations, you will exit yourself out of prosperity. And let me ask you this. Do you want to be right, or do you want to be wealthy? Because they are not the same. A man who takes small profits constantly may feel right often. His ego is satisfied. But his account grows slowly, if at all. The trader who waits for the big move may endure uncomfortable retracements. But when he is right in size and in duration. The money mindset of a successful trader is not built on excitement. It is built on acceptance. Acceptance that markets breathe. Acceptance that no trend moves in a straight line. Acceptance that unrealized profit is not a possession until the market confirms your exit. You see, there is a difference between hope and patience. Hope ignores evidence. Patience respects the trend. When the chart shows distribution, lower highs, expanding volume on declines, failure to reclaim resistance. That is not the time to hope. That is the time to exit. But until the evidence appears, why interfere? Many traders sabotage themselves because they trade their fears instead of their plans. They enter with a strategy but exit with emotion. They promise to trail a stop under higher lows, but the moment price hesitates, they abandon the plan. And afterward, they blame the market. The market is not to blame. It simply moves. One must decide in advance what constitutes a legitimate exit. Is it a close below the 50-day moving average on heavy volume? Is it a break of a key support level? Is it a failed breakout with immediate reversal? Define it. Write it down. Then honor it. Without such rules, you will exit at precisely the wrong moment, when discomfort is greatest and opportunity still alive. Wealth in trading does not come from frequent action. It comes from aligning yourself with a major move and allowing it to work. That requires capital, yes, but more than capital, it requires temperament. Temperament is the difference between a speculator and a gambler. The gambler seeks quick resolution. The speculator accepts uncertainty. The gambler cannot endure open profit fluctuating. The speculator understands that fluctuation is normal. Which one are you? Consider the trader who compounds his account not by trading more, but by letting a single strong trend multiply his capital. A 20% move becomes 40%, becomes 60%, not because he added recklessly, but because he did not exit prematurely. He pyramided wisely, adding only when the market confirmed his thesis. That is how wealth is built in speculation. Methodically, patiently, with respect for trend. But it all collapses if you cannot master the exit. If you cut your winners the moment they become meaningful, you will always feel as though the market is against you. In truth, you are against yourself. The chart offered you a roadmap. The trend offered you opportunity, but you chose relief over reward. And so the question remains, when the next trade begins to work in your favor, will you listen to the noise of your fears? Or to the message of the market? The market pays the patient man, not the nervous one. I learned that lesson the hard way. The market has a peculiar habit of rewarding the man who can sit still and punishing the one who must always be doing something. It is not brilliance that builds a trading account. It is not speed. It is not even superior prediction. It is patience. Most traders believe the money is made in action. They feel alive when they are buying and selling. They equate movement with progress. But the truth is, the real money is made in the waiting, in the holding, in the quiet confidence that comes from knowing the trend is on your side. Have you ever noticed how uncomfortable it feels to sit on a winning position? When price pulls back a little, your mind begins to whisper. Take it now. Lock it in. Don't let it slip away. That whisper has cost traders more fortunes than bad analysis ever did. A nervous man cannot hold a position long enough to let it mature. He watches every tick. He studies every minor fluctuation. A stock moves 2 points against him within an uptrend, and he sees disaster. He sells. Then the stock resumes its climb without him. The trend was intact. The structure was sound. Only his nerves were shaken. The patient man sees the same pullback and understands it differently. He knows trends breathe. He knows strong advances are built on waves, advances followed by controlled retreats, then advances again. He studies the volume. He observes whether support holds. He asks, has anything truly changed? If the answer is no, he sits tight. That is the difference. Patience in trading is not passive. It is disciplined observation. It is a conscious decision to let the market confirm or deny your position according to evidence, not emotion. When a stock breaks out from a solid base with expanding volume and enters a clear uptrend, the patient trader understands that this move may last weeks or months. He does not rush to grab the first modest gain. The nervous trader does. The nervous trader sees a 5% gain and feels triumphant. Then he feels afraid. He fears losing that 5% more than he desires, gaining 15 more. So he exits. He feels safe for a moment. But safety does not build capital. Let me ask you something. Do you trade to feel comfortable, or do you trade to grow your account? The market does not reward comfort. It rewards conviction supported by facts. When higher highs and higher lows form, when pullbacks occur on lighter volume, when the broader market supports the move, that is not a signal to exit. That is confirmation. Yet the nervous man interprets every pause as a threat. The patient trader understands that volatility is part of the process. He has already defined his exit before he entered the trade. Perhaps it is a break below a key support level. Perhaps it is a violation of the 50-day moving average on heavy volume. Whatever the rule, it is objective. He does not invent new rules mid-trade because his emotions demand relief. Relief is the enemy of growth in speculation. If you examine the great market moves, the kind that double or triple in value, you will find they did not travel in straight lines. They tested holders repeatedly. They shook out weak hands. They created doubt. Only the patient remained. And patience is not blind hope. There is a great difference. Hope ignores evidence. Patience studies it. If distribution appears, lower highs forming, heavy selling volume, failed rallies at resistance, the patient trader will exit without hesitation. He is not stubborn. He is simply steady until the facts change. The nervous man exits before the facts change. There is also a deeper principle at work here. Wealth in trading compounds when large gains are allowed to run. A series of small gains, constantly harvested, rarely produces meaningful growth after commissions, slippage, and inevitable losses. But one sustained trend can offset many small mistakes. Yet that sustained trend requires time. Time is what the nervous trader cannot tolerate. He wants immediate validation. He wants proof that he was right. The market rarely provides that proof in a straight, uninterrupted fashion. It moves in waves. It advances, consolidates, and advances again. During consolidation, doubt creeps in. What do you do when doubt creeps in? Do you consult the chart, or do you consult your fear? The patient man consults the chart. He asks whether support is intact. He studies whether volume confirms the price action. He observes whether the overall market environment has shifted. If the structure remains bullish, he remains invested. This is not easy. It requires temperament. Temperament is more valuable than intelligence in speculation. A brilliant analyst with weak nerves will underperform an average analyst with strong discipline. Because the market ultimately rewards behavior, not theory. Consider how many traders exit a position the moment it becomes meaningful. A trade begins to show real profit, and suddenly the stakes feel larger. The numbers on the screen represent something tangible. The fear of giving it back intensifies, and so they sell, not because the trend ended, but because the profit became large enough to frighten them. That is nervousness disguised as prudence. True prudence is having a plan and following it. True patience is allowing the market room to fluctuate within its natural rhythm. If you cannot endure temporary pullbacks within a primary trend, you will never capture the full move. And capturing the full move, or at least the heart of it, is where accounts grow. You must decide what kind of trader you intend to be. The nervous trader will always be busy, always active, always reacting. The patient trader will appear almost inactive at times, but when he acts, it will be decisive and aligned with the major trend. The market pays the patient man because he gives his positions time to prove themselves. He does not suffocate them with constant interference. He does not uproot the seed every day to see if it is growing. He simply waits. Small losses are protection, small profits are limitation. There is a great misunderstanding among traders. They believe that because both losses and profits affect the account balance, they must be treated the same way. But they are not the same. A small loss is insurance. A small profit, taken too quickly, is a ceiling placed upon your own success. When I speak of small losses, I speak of discipline. A trader must know when he is wrong. If a breakout fails, if support gives way on heavy volume, if price violates the structure that justified the entry, then the position must be closed without hesitation. That loss, taken early, protects your capital. It protects your confidence. It keeps you in the game. But small profits, taken out of fear rather than evidence, do something different. They protect your emotions, not your capital. And protecting your emotions has never built wealth in speculation. Have you noticed how eager most men are to take a profit? A stock moves 5% in their favor and suddenly they feel clever. 10% and they feel brilliant. Then comes the fear. What if it comes back? And so they sell. They congratulate themselves for being prudent. Prudent or impatient. The market does not produce large gains in a single breath. It produces them in waves. If you study any sustained trend on a chart, you will see advances followed by orderly pullbacks. Those pullbacks are not signals of failure. They are part of the advance. But to the man watching his open profit fluctuate, they feel like danger, and so he takes the small gain. The irony is this: the same trader who refuses to take a small loss will eagerly take a small profit. He lets his losing trades linger, hoping they recover, and cuts his winners short, fearing they will retreat. He has reversed the logic of successful speculation. Small losses must be embraced quickly. Small profits must be resisted. Why? Because the mathematics of trading demand it. If your average loss is larger than your average gain, you will struggle to grow your account no matter how often you are right. You may boast of a high win rate. You may tell yourself that you are accurate, but if your winners are consistently capped while your losers are allowed room, the numbers will work against you. Let me ask you, would you rather be right often or profitable over time? A small loss of 2 or 3% is manageable. It is the cost of doing business. It is tuition paid to the market. It leaves your capital largely intact, so you may participate in the next opportunity. But a small profit of 3%, taken from a stock that later runs 30%, is not tuition. It is forfeited opportunity. Opportunity is where wealth resides. When a stock breaks out from a well-formed base, with volume expanding and the general market supportive, that is not a moment for timid expectations. That is a moment for measured conviction. You define your risk clearly, perhaps just below the breakout level or beneath recent support. If price returns there, you exit with a small loss, simple, clean, controlled. But if the breakout holds and price begins forming higher highs and higher lows, the structure is telling you something. It is telling you demand is in control. It is telling you the path of least resistance is upward. Why, then, would you limit that potential by snatching at the first modest gain? Because you are nervous. Because you fear giving back what you have not yet truly earned. A profit is not earned simply because it appears on your screen. It is earned when the market confirms that the trend has matured or reversed. Until then, it is merely part of the unfolding move. To seize it prematurely is to declare the move complete without evidence. The professional speculator thinks in terms of asymmetry. Risk a little to make a lot. That is the foundation. If you risk 3% to potentially gain 15 or 20, you need not be right every time. The math favors you. But if you risk 3% and routinely take 5% profits, your edge is thin. Add a few larger losses due to hesitation, and the edge disappears. This is why small losses are protection. They keep risk defined and limited. They prevent one mistake from becoming catastrophic. They preserve emotional stability because you know the maximum damage in advance. There is no panic when the stop is hit. It was planned. Small profits, however, often come from unplanned exits. They are emotional reactions to temporary fluctuation. They reflect a mindset that seeks certainty over growth, and certainty does not exist in the market. The chart must guide you. If the uptrend remains intact, higher lows respected, moving averages rising, volume supportive, then your position deserves room. Not unlimited room, but structured room. You trail your stop logically, perhaps beneath prior swing lows or beneath a key moving average. You allow the trend to breathe. Breathing room is what transforms a trade into a meaningful gain. There will be times when a breakout fails quickly, and you take your small loss. That is fine. That is business. There will also be times when a breakout works beautifully and trends far beyond your expectations. Those are the trades that define your year. Those are the trades that compound your account. But you will never capture them if you are conditioned to accept only small rewards. Many traders mistake activity for productivity. They believe frequent small gains indicate progress. But when they review their accounts after months of effort, they find little growth. Why? Because they have limited their upside while allowing normal drawdowns to erode their capital. It is not about holding blindly. It is about holding intelligently. When distribution appears, when price begins forming lower highs, when rallies fail at resistance, when heavy selling volume emerges, that is your signal. Then you exit, perhaps with a substantial gain, perhaps giving back a portion of open profit. That is part of the process. But until that evidence appears, why interfere? A trader must cultivate a mindset that welcomes small losses as allies and views small profits with suspicion. One protects the account. The other may be quietly strangling it. The difference lies not in the numbers themselves, but in the reasoning behind them. Discipline on the downside. Patience on the upside. That is the balance. Watch the chart, not your open profit. If there is one habit that separates the seasoned operator from the anxious amateur, it is this: the seasoned man studies price. The amateur studies his profit and loss. One looks at structure, volume, trend. The other looks at dollars fluctuating on a screen. And the screen can make a coward out of a brave man. When you enter a trade, your analysis is based on the chart. You identify accumulation. You observe a breakout from resistance. You notice expanding volume confirming demand. You define your risk beneath support. Everything about your decision is rooted in price behavior. But the moment the trade begins to move, something shifts. Instead of watching higher highs and higher lows, you begin watching your open profit. Instead of asking whether the trend remains intact, you ask how much money you might lose if it pulls back. And from that moment forward, you are no longer trading the market. You are trading your emotions. Have you ever sold a perfectly strong stock simply because the dollar amount on your screen made you uncomfortable? That discomfort does not come from the chart. It comes from attachment. An open profit feels like possession. You begin to think of it as yours, and the thought of losing part of it feels like theft. But the market does not recognize your sense of ownership. It recognizes only supply and demand. Until you exit according to your plan, the trade is still unfolding. The chart is objective. Your open profit is not. Consider a stock trending upward in a clean channel. It advances for several days, then pulls back 2 or 3% on lighter volume. Structurally, nothing is wrong. Support holds. Buyers step in near prior swing lows. The moving averages continue to rise. From a chart perspective, the trend is healthy. But if your position size is large, the 2 or 3% pullback may represent a significant dollar amount. Suddenly, you feel tension. You begin calculating how much you are giving back. And so you exit, not because the chart signaled weakness, but because your account balance flickered. You abandoned evidence for emotion. The market's language is price and volume. It does not speak in dollars. It does not care whether you are up 500 or 5,000. It cares only whether demand is stronger than supply. When you shift your focus from price structure to profit fluctuations, you lose fluency in the only language that matters. Let me ask you, when you entered the trade, did you base your decision on your profit target or on the chart pattern? If it was the pattern, then why would you abandon the position before the pattern fails? This is where discipline comes into play. Before you enter, you must define your exit conditions. Perhaps you decide to sell if price closes below a key support level. Perhaps you trail your stop beneath higher lows as the trend progresses. These are chart-based decisions. They are rational. They are consistent. Watching your open profit introduces inconsistency. One day you may tolerate a 3% pullback. Another day, depending on how large the dollar figure appears, you may panic at 2%. The chart did not change. You did, and that inconsistency will erode your results over time. It is a peculiar thing. Traders who cut winners short often believe they are being cautious. In truth, they are allowing fear to dictate strategy. Fear of losing unrealized gains. Fear of regret. Fear of watching the number shrink. But what is a number without context? If a stock advances 20% over several weeks and then retraces 5% within an ongoing uptrend, is that weakness? Or is it normal consolidation? The chart will tell you. The profit column will only tell you how much has changed in your account. Serious speculation requires detachment. Not indifference, but detachment from the emotional swings of fluctuating equity. You must be able to observe your position as if it were someone else's. Ask yourself, if I had no position, what would this chart suggest? Would I see strength or weakness? If the answer is strength, then why are you selling? Often, traders check their profit and loss far too frequently. They measure success minute by minute. But the market's meaningful moves unfold over days and weeks. By focusing on intraday fluctuations in profit, you magnify noise and ignore structure. Noise is the enemy of patience. The chart smooths out noise when viewed properly. A daily or weekly time frame reveals trend. It reveals whether price respects support, whether breakouts hold, whether volume confirms advances. These elements matter. Your open profit does not. Imagine two traders holding the same stock. One stares at his account balance all day. The other studies the chart at the close and reviews the structure calmly. When the stock dips slightly, the first feels alarm. The second sees a routine pullback to the 20-day moving average. Who is more likely to hold for the larger move? Who is more likely to exit prematurely? Wealth in trading comes from capturing meaningful portions of major trends. Major trends require time. Time requires emotional stability. Emotional stability requires that you anchor your decisions to objective criteria, not fluctuating dollar amounts. The moment you begin managing your trade based on how much money is at stake, you are no longer following the market's message. You are following your fear of loss, and fear has no place in analysis. That does not mean you ignore risk, quite the opposite. Risk is defined before entry. You determine the maximum acceptable loss. You size your position accordingly. Once the trade is live, your job is not to protect every cent of open profit. Your job is to monitor whether the original thesis remains valid, if price begins forming lower highs, if volume expands on declines, if key support levels are broken decisively. That is information. That is reason to act. But until such evidence appears, fluctuation alone is not a signal. You must train yourself to look first at price, then at volume, then at structure. The profit column should be secondary, almost irrelevant, until your exit criteria are met. Otherwise, you will find yourself repeatedly selling strong stocks during temporary weakness, only to watch them resume their climb without you. The chart tells the truth. Your open profit tells a story of emotion. Volatility is the toll you pay for larger gains. Every man who enters the market desires profit. Yet few are willing to endure the price that profit demands. That price is not paid in effort alone. It is paid in emotional discomfort. It is paid in fluctuations. It is paid in watching a position move in your favor, then against you, then in your favor again. That movement, that restless shifting of price, is volatility. And volatility is not the enemy. It is the admission fee. Most traders claim they want large gains. They speak of catching trends, of riding major moves. But when price begins to swing, when candles lengthen and ranges expand, they grow uneasy. They begin to doubt. They begin to tighten stops irrationally. They begin to exit not because structure failed, but because the movement feels violent. Have you ever noticed how a stock often becomes more volatile just before it makes a substantial advance? Breakouts rarely occur in silence. They are accompanied by expanding volume, wider daily ranges, and emotional participation from the crowd. Weak hands are shaken out, shorts are squeezed, momentum traders pile in. The price may swing sharply within a single session. To the untrained eye, it looks dangerous. To the seasoned operator, it looks alive. You cannot have expansion without movement, and you cannot have movement without volatility. Consider a stock forming a solid base for weeks. Price tightens, volume contracts, the range narrows, it appears calm. Then one day it erupts above resistance on heavy volume. The daily range doubles. The stock pulls back intraday, then surges again. That is volatility announcing opportunity. But what does the average trader do? He buys the breakout, sees a swift pullback of 3 or 4%, and panics. It's too unstable, he says. He exits. The stock consolidates briefly, and then advances 20% over the next month. He wanted the gain, but he rejected the toll. Volatility tests conviction. It exposes whether your belief in the trade is rooted in analysis or in comfort. If your position size is too large for your temperament, volatility will force you out. Not because the trade is wrong, but because your nerves cannot endure the swings. That is why position sizing is critical. If you risk too much on a single trade, normal price fluctuations will feel catastrophic. A routine retracement will feel like collapse, and you will abandon sound positions prematurely. Let me ask you, Are you sizing your trades so that you can think clearly during volatility, or so that you can feel excitement? Excitement is expensive. The professional speculator expects volatility. He plans for it. Before entering, he identifies support levels. He studies prior pullbacks within the trend. He asks, how much movement is normal for this stock? If the average retracement during an uptrend is 5%, then a 3% dip is not a reason to flee. He understands that volatility is part of price discovery. Markets move because participants disagree. Buyers and sellers clash. That clash creates movement. If everyone agreed on value, price would not move at all. It is the very tension between fear and greed that creates opportunity. When volatility increases during an uptrend with strong volume, it often reflects aggressive buying. Institutions do not accumulate quietly forever. When they decide to move, they move with size. Their orders push price rapidly. Pullbacks may be sharp but brief.